Thank you for joining us for the Federal Deposit Insurance Corporation's information session for bank directors on the Community Reinvestment Act, one of several sessions being developed as part of the FDIC's Community Banking Initiative. I'm Julie Banfield, Deputy Regional Director with the FDIC's Division of Depositor and Consumer Protection. This presentation is an overview of the Community Reinvestment Act and FDIC's implementing regulation, Part 345. It's designed to provide bank directors with foundational knowledge regarding the Act and the implementing regulation, which are commonly referred to as CRA. During this session, we'll discuss the purpose of the Act, different CRA evaluation types, how to comply with CRA, and practical ideas to assist your institution in helping to meet the credit needs of its assessment areas. The FDIC's goal for the session is to outline a bank's CRA responsibilities and to emphasize that your role as a bank director is vital to the process. The slides used in our presentation can be found on www.fdic.gov. We hope you find the information beneficial for you and your institution. Here with me now to share information with you are Assistant Regional Director Chris Finnegan and Field Supervisor Rafael Valle. Chris will now discuss some background information on CRA.
Let's start out by covering the purpose of CRA. The Community Reinvestment Act was signed into law as Title VIII of the Housing and Community Development Act of 1977. CRA was enacted in an effort to encourage lenders to make more loans in their communities to help stabilize and revitalize deteriorating neighborhoods throughout the country. The statute details three findings by Congress and the purpose of CRA. The findings were: 1. Regulated financial institutions are required by law to demonstrate that their deposit facilities serve the convenience and needs of the communities in which they are chartered to do business. 2. The convenience and needs of communities include the need for credit services as well as deposit services. And 3. Regulated institutions have a continuing and affirmative obligation to help meet the credit needs of the local communities in which they are chartered. The law's purpose is to require each appropriate federal financial supervisory agency to use its authority when examining financial institutions, to encourage such institutions to help meet the credit needs of the local communities in which they are chartered, including low and moderate income borrowers and geographies, small businesses, and small farms. Since 1977, the CRA has been modified by the enactment of several other laws. However, none of the modifications have changed the purpose of the Act. As previously stated, the statute encourages lenders to help meet the credit needs of their local communities and requires federal regulators to assess the financial institution's record of doing so. Through a provision in the CRA, Congress delegated to the federal regulators the task of creating regulations to carry out the purposes of the CRA. In 1978, the federal bank regulatory agencies issued joint regulations implementing the CRA. The FDIC's implementing regulation is Part 345, Community Reinvestment. The implementing CRA regulations have been revised over time, and our presentation will focus on the requirements applicable in 2013.
It's important to reiterate that CRA requires the FDIC to evaluate your bank's record of helping to meet the credit needs of its local communities, including low and moderate income neighborhoods. The Act also requires that these efforts always be performed within the standards of safe and sound banking operations. Before we discuss how FDIC evaluates your bank's CRA performance, Rafael will cover the record-keeping, disclosure, and notice requirements of the CRA regulation.
There are three requirements associated with records, reporting, and disclosures. The first of these requirements is that your bank must place in the public lobby of your main office in each of your branches a public notice. This notice must state that the public is entitled to certain information about your bank's operations and your performance under the CRA. The second requirement is that your bank must maintain a file that is available for public viewing that includes certain information specified in the regulation. The third item requires large banks to collect and report certain data pertaining to the bank's small business, small farm, and community development lending activities. If your bank is transitioning from a small to a large bank, it is critical to develop a strong framework for data collection and effective staff training. The definition of what constitutes a small or large bank for CRA purposes would be provided later in this presentation. Another requirement is to delineate one or more assessment areas within which the FDIC evaluates the bank's record of helping to meet the credit needs of its community. Chris will explain the requirements for delineating CRA assessment areas, which is a function that a bank director will definitely be involved in.
As Raphael noted, the CRA regulation requires a bank to delineate one or more assessment areas within which the FDIC will evaluate your bank's record of helping to meet the credit needs of your community. It is the board's responsibility to ensure that the assessment area is properly designated for your bank. So, what must your bank remember when delineating an acceptable assessment area? The regulation places some requirements and restrictions on how assessment areas should be delineated. First, the assessment area should consist of whole political subdivisions, such as metropolitan statistical areas, counties, cities, or towns, and must contain whole census tracts. When designating your assessment area, you cannot split a census tract in half. Your bank should either include the entire census tract or exclude it. Next, the assessment area may not reflect illegal discrimination or arbitrarily exclude low or moderate income census tracts. Finally, your bank's delineated assessment areas must include all of the geographies in which your bank's main office, branches, and deposit-taking ATMs are located, as well as surrounding areas in which your bank has originated or purchased a substantial portion of its loans. The term substantial portion is not defined by the regulation, but generally means more than 50% of your home mortgage, small business, and small farm loans. It is important to remember that the bank's delineated assessment area should be evaluated on a periodic basis to ensure it is changing as the bank expands or contracts. Now Raphael will discuss performance context.
One of the most important components of the CRA evaluation is considering the bank's performance context. The CRA regulation recognizes that banks do not operate in a vacuum, that every institution deals with unique circumstances. One size definitely does not fit all. Examiners will not dictate what products your bank has to offer, as each bank is responsible for developing its own business strategy. Therefore, your bank's performance is evaluated within the context of the environment in which it operates. The idea of performance context includes a broad range of economic, demographic, institution-specific, and community-specific information that examiners review to understand the local environment in which your bank is operating. One of the key purposes of the performance context is to determine what opportunities for lending, investing, and providing services exist in an assessment area. To obtain this information, examiners will contact area, business, and community leaders for their opinion on what is needed in the community. These community contacts are important in helping to establish your bank's performance context. Now I'll turn it back over to Julie to discuss CRA examination types.
In 1995, and again in 2005, changes to the CRA regulation were made to prescribe different examination procedures for the different types of institutions. The small bank CRA examination is a streamlined review of your bank's lending performance. For intermediate small banks, commonly referred to as ISBs, the examination combines the small bank lending test with a community development test. We'll talk more specifically about these first two types of bank examinations a little later in the presentation. For large banks, the examination includes an expanded performance review. The examination involves a comprehensive review of your bank's lending, qualified investments, and services. If your bank is a large bank, you must also collect and report certain loan data. The vast majority of banks are evaluated using one of these first three types of examinations, but there are two other examination types used by a relatively small number of banks. Limited purpose and wholesale banks are subject to an examination that focuses only on the bank's community development activities. These banks are evaluated solely under the community development test. Finally, all banks are permitted to establish their own strategic plan for CRA evaluation purposes, subject to regulatory approval. When establishing a CRA strategic plan, you must include specific, measurable, and quantifiable annual goals. Public participation is required, including formally soliciting public comment on the proposed plan. Your examiners will then measure your performance against your stated goals when evaluating your CRA performance. You may want to consider this option if your bank has a unique niche. Next, Chris will discuss the asset thresholds for small, intermediate small, and large banks.
Under the CRA rules, a small bank is defined as a bank with assets less than $296 million as of December 31st in either of the 2 prior calendar years. An intermediate small bank is a bank with assets of at least $296 million for both of the previous 2 calendar years, and less than $1.186 billion in either of the prior 2 calendar years. Since assets tend to fluctuate and could be over the $296 million threshold in one year and decrease below the threshold the following year, it is important to keep in mind that you have to exceed the threshold both of the 2 prior years in order to be an ISB. A large bank for CRA purposes has total assets of at least $1.186 billion as of December 31st in both of the prior 2 calendar years. As mentioned previously, large banks are subject to CRA loan data reporting requirements. The regulation allows a full calendar year to comply with these data reporting requirements. A bank should provide the necessary resources to ensure accurate reporting. Please note that the CRA asset size thresholds are indexed and change each year. The thresholds used in this presentation were effective as of January 1st, 2013. Now Raphael will explain why small banks are treated differently.
Small banks generally have more limited staffing and expertise available for the CRA function. Small banks also typically do not have an employee dedicated to CRA. The CRA program is often run by a committee with a member of senior management serving as the CRA officer. This person likely wears many hats on a daily basis. Additionally, due to their size, small banks typically have limitations on the breadth and volume of products they can offer. With these issues in mind, the regulation created a more streamlined examination approach for small and intermediate small banks. Now I will describe the streamlined examination approach for small banks. The majority of FDIC supervised banks are evaluated using the Small Bank Performance Criteria. These criteria focus solely on the bank's lending activity, with emphasis on how well a bank is serving the credit needs of low and moderate income borrowers and census tracts, small businesses, and small farms. Performance is evaluated using 5 criteria. First, the average net loan-to-deposit ratio is calculated using each quarterly loan-to-deposit ratio since the prior CRA evaluation. This measures the extent to which the bank is lending in relation to its deposit base. Next, the assessment area concentration is evaluated by determining the percentage of loans originated inside the assessment area versus outside. To satisfy this criterion, your bank needs to have more than half of its lending inside the assessment areas. Another criterion is borrower distribution, which measures the proportion of your bank's lending to the various income groups of individual borrowers inside your designated assessment areas. For example, low-income borrowers, moderate-income borrowers, and so on, as well as the proportion of your bank's lending to small businesses and small farms based on gross annual revenues. The fourth criterion is geographic distribution of loans. This measures the proportion of your bank's lending in the various income categories of census tracts located inside your assessment areas. Last, the FDIC will assess your bank's response to any written CRA complaints received by the bank since the last CRA evaluation. Any CRA complaints and your bank's response should also be included in your CRA public file. Banks have the option to receive consideration to enhance a satisfactory rating by including the evaluation of qualified community development investments and retail services. If you would like to consider this option, please be sure to inform the examiners at the beginning of the review.
What tests apply to an intermediate small bank? The FDIC will evaluate your bank's performance using a lending test and a community development test. The lending test measures the same 5 performance criteria as Raphael just covered for small banks. The community development test measures your bank's responsiveness to community development needs through the combination of loans, investments, and services. For any of these activities to qualify, it must have community development as its primary purpose. An intermediate small bank can only receive a satisfactory or better CRA rating if it receives at least a satisfactory rating on each of these 2 tests. In other words, your bank must demonstrate at least satisfactory performance on both tests to be considered satisfactory or better for CRA purposes. As a bank transitions from being a small bank to becoming an intermediate small bank, a common question is, what constitutes community development? The CRA regulation defines community development with 5 main components. The first is providing affordable housing for low or moderate income individuals. This includes multifamily housing. The second component is community services targeted to low or moderate income individuals. This would include community or tribal-based, child care, educational, health, or social services that are targeted to serving the needs of low or moderate income individuals or families. The next component is promoting economic development by financing small businesses or small farms. To qualify under this prong of the definition, the activity must meet a size and purpose test. The fourth component of community development is activities that revitalize or stabilize low or moderate income census tracts, designated disaster areas, or distressed or underserved non-metropolitan middle-income census tracts. The fifth and final prong of community development was added in January 2011. To qualify under the abandoned or foreclosed homes prong, the loan, investment, or service must support eligible development activities in areas designated under the Neighborhood Stabilization Program administered by the Department of Housing and Urban Development. Please note, to qualify as community development, the activity must meet one prong, not all prongs. A few examples of community development activities include placing a certificate of deposit with a minority depository institution, instructing a Money Smart session at a local school with primarily low to moderate income students, or providing the financing of a multifamily dwelling that houses primarily low and moderate income individuals.
Now we'll move into a brief discussion regarding large bank performance criteria. 3 tests are required for the evaluation of large bank performance. The first test is the lending test, which is similar to the lending test for small and intermediate small banks that we've previously discussed. However, your bank's use of innovative or flexible lending practices to address the credit needs of low or moderate income individuals or census tracts is also given consideration in the large bank evaluation, as is the bank's community development lending. The second test is the investment test, which evaluates the dollar amount, innovativeness, complexity, and responsiveness of your bank's qualified community development investments. The final test is the service test, which evaluates the availability and effectiveness of your bank's system for delivering retail banking services, and the extent and innovativeness of the community development services provided by your bank. Of course, all these activities must be performed in a safe and sound manner. Raphael, can you please describe what ratings an institution can be assigned based on its CRA performance?
Sure. The examiner carefully reviews the available data for the various performance tests, considers the institution's performance context, and determines the appropriate overall CRA rating. There are 4 possible ratings a bank can receive. The best rating is outstanding, which is assigned to an institution with an outstanding record of helping to meet the credit needs of its assessment areas, including low and moderate income neighborhoods, in a manner consistent with its resources and capabilities. The other ratings are satisfactory, needs to improve, and substantial noncompliance.
Your institution's overall CRA rating can be affected by substantive findings of discrimination or other illegal credit practices. When these types of violations, inconsistent with helping to meet community credit needs, are identified, the CRA evaluation will state that substantive violations were found. Examples include discriminatory violations of the Equal Credit Opportunity or Fair Housing Acts, as well as violations of Section 5 of the Federal Trade Commission Act involving unfair or deceptive acts or practices. The evaluation will indicate whether the violations caused the CRA rating to be adjusted downward and briefly explain why the rating was or was not adjusted. The evaluation will identify the law and regulation violated, the extent of the violations, for example, widespread or limited to a particular office, and characterize management's responsiveness in correcting the violation. So you can see it is important to have all areas of your lending program in order.
Thank you, Chris. Now, Raphael, can you please address how CRA performance could impact an institution?
Yes, there are a number of different ways. First, your bank's CRA rating and performance evaluation are public information. Therefore, your competitors, local community groups, and your customers have access to your bank's CRA rating and performance evaluation. They may use this information to determine whether to continue doing business with you or to challenge, through a CRA protest, the opening of a new branch or a proposed merger. The FDIC also considers CRA performance when evaluating bank applications. Less than satisfactory CRA performance may result in denial or conditional approval of an application to open new offices or acquire another financial institution, thus impacting your bank's ability to expand.
Thank you, Raphael. Can you now explain the frequency of CRA examinations?
The CRA examination frequency was altered as a result of the Gramm-Leach-Bliley Act in 1999. The Act extended the CRA examination frequency for banks with total assets of $250 million or less to at least 4 years if an institution has a satisfactory CRA rating, and at least 5 years if the institution receives an outstanding CRA rating. However, the regulators may conduct a CRA evaluation at any time for cause. If you have questions about the timing of your next CRA examination, you can contact FDIC regional or field office management.
While most banks do a good job meeting CRA requirements, there can be challenges to your institution. Chris, can you please describe some of those challenges?
Sure. One of the challenges is for banks transitioning from a small bank to an intermediate small bank. The primary difference between the CRA examination for a small bank and for an ISB is the addition of the community development test. When your bank is approaching the asset threshold to be considered an ISB, you need to begin preparing for the community development test. Remember, there is a built-in transition period since you will not be evaluated as an intermediate small bank until your year-end assets exceed the established threshold for 2 consecutive year-ends. Likewise, banks transitioning from an ISB to a large bank may have challenges with the 3 large bank test. Such banks should consider the innovativeness of lending products and available opportunities in the assessment area for investments and services that may assist low and moderate income borrowers and geographies. You should also consider contacting the community affairs staff in your FDIC regional office to discuss additional community development opportunities as your bank prepares to transition to a new CRA test. Another fairly common challenge is when a bank purchases a large volume of loans from outside its assessment area. In addition to safety and soundness considerations, management and the board should consider the potential CRA implications before making these purchase decisions. Remember, one of the performance criteria in the lending test for any size bank is the proportion of your lending inside your assessment areas. In order to have satisfactory performance on this criterion, your bank must originate or purchase more than half of its loans from inside your assessment area. If your bank purchases a large volume of loans from outside your area, you will need to consider how this fits into your overall CRA strategy and performance.
Now let's discuss some practical ideas that may assist your bank in helping to meet its CRA responsibilities. These ideas include developing a CRA strategy, performing self-assessments, and utilizing FDIC resources. Raphael and Chris will spend the next few minutes providing more information on each of these areas.
Our first suggestion is to develop a CRA strategy for your bank that considers your current size and business model, as well as any future plans. An effective CRA strategy can help your management team and staff understand the connection between the well-being of the bank and the well-being of your community. One cannot prosper without the other. It is important to ensure that your employee responsible for CRA compliance is involved in this process. He or she should have a good understanding of your local community and can provide valuable assistance to the board in this process. When developing a CRA strategy, it is important to foster relationships with state and local officials, community groups, and others involved in your community. These relationships can help your bank identify unmet needs in the community. When considering new products to meet the community's needs, we encourage banks to review the FDIC's Model Small Dollar Loan Program for safe and affordable loans, as well as the Safe Deposit Accounts model. The Small Dollar Loan Program promotes affordable small dollar loans that have a risk-based, streamlined underwriting process. The Safe Account is a low-cost transaction and savings account designed to target underserved and low and moderate income consumers. Most bankers participating in the Small Dollar Loan Program pilot indicated that these small dollar loans were used to develop or retain long-term relationships with customers. Likewise, participants in the Safe Deposit Account pilot suggested that safe accounts may have greater longevity and lower cost than other deposit accounts and perform similar to or better than other transaction and savings accounts.
Another idea for your bank to consider is performing regular self-assessments of your CRA performance and assessing the adequacy of your delineated assessment area. In conducting an assessment, your bank would monitor performance in home mortgage, small business, and small farm lending as applicable. You would then compare your results to Home Mortgage Disclosure Act aggregate data or demographic data available from the U.S. Census Bureau. Your bank would look for areas of weak performance and implement measures to improve that performance. The developed monitoring system should identify any gaps in your performance and track progress toward meeting your established CRA goals. Since CRA performance evaluations are public documents, you can also compare your performance to that of your local competitors. Reviewing your competitors' public performance evaluations may also give you insight into community development opportunities that your bank would want to consider. As a member of the Board of Directors, you should be aware of your bank's CRA performance. Therefore, board reporting is an essential part to any successful CRA strategy.
What information is available to help banks comply with CRA?
The interagency questions and answers regarding community reinvestment, CRA Q&As, are a great resource for guidance on CRA requirements, as well as community development information. Another resource is the Guide to CRA Data Collection and Reporting. While the guide is only applicable to large banks and their data collection and reporting requirements, smaller institutions may also find some of the information contained in the guide useful to their CRA operations. There are a number of resources available through FDIC for banks to use to enhance their CRA performance. Bankers should consider contacting the FDIC's Community Affairs staff. They are located in each region and can be a helpful resource to your bank. They can provide information on the community development opportunities in your area, as well as public information about other banks competing in your local community. You can also receive technical assistance regarding CRA by contacting your FDIC regional or field office management. In addition, the FDIC's National Survey of Unbanked and Underbanked Households, released in September of 2012, provides detailed information about potential opportunities for financial institutions. And as I mentioned previously, the FDIC has models for small dollar loan programs and safe deposit accounts.
We encourage you to view these resources and use them to strengthen your CRA performance. Effective community reinvestment is a win-win proposition for all banks and for the communities they serve. This concludes our presentation on the Community Reinvestment Act for Bank Directors. We hope that you found the presentation helpful. If you have additional questions regarding CRA, please send them to the mailbox supervision@fdic.gov. On behalf of Chris, Raphael, and myself, we appreciate your participation and thank you for your commitment to your local community.